Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. Today is March 19th, a few days after St. Patrick's Day. We're back to talk about the pullback in the markets, Ernest. Quick review of that, as well as I think those that like Constellation and Topicus will be very excited about this episode as we're going to talk the Q4 earnings results for Constellation and Topicus. The year is over. It wasn't as an exciting year as 2023 for the company, but very exciting start to 2025 for both Constellation and Topicus.
Right.
So before we get into that, let's do a little housekeeping. If you love this podcast, we really would appreciate if you would subscribe to us on YouTube, on Apple, and Spotify. Please leave us a 5-star review. Please tell your friends. And if you have any interest in Baskin Wealth Management and our services, please reach out. We'd love to discuss your wealth management solutions for you in the future. So with that, let's get into the tough start to 2025 for U.S. markets, not necessarily world markets. If you look, Ernest, the TSX is, as of today, March 19th, this is before the Federal Reserve meeting, the TSX is actually positive year to date. The Canadian dollar positive year to date against the U.S. dollar. Hang Seng, the Asian markets are positive. European markets are positive. So we got a few interesting things going on. Is it a little bit of mean reversion? The bloom is off the rose from U.S. stocks because of Trump's flip-flopping and antics and worries about tariffs. Is it high valuations for U.S. companies versus lower valuations for non-U.S. companies? It's a whole bunch of things, obviously. But I guess those that have been saying for years that international is really cheap against the U.S. they're finally having their little moment in the sun.
Right. So I think those are two separate points about whether international stocks are going to outperform the U.S. Going forward. Mm-hmm. And I think that's a separate question than what U.S. stocks are going to do on an absolute basis.
For sure. And it's such a generalization, of course. I think we talked about on this podcast before about, we like to buy high quality owner operated businesses with recurring revenues. And if you look to buy those businesses, even if they're domiciled in Europe or Norway or wherever they are, it's not like they're giving them away versus the high quality names that you find in US or Canada, right? So it's no question the valuations, there's just more better companies in the US. So it was always trading at a high, the S&P 500 was trading at a higher valuation as a result. And I think the pullback on some of those names was, probably for good reason. Tesla was trading at such an enormous valuation, represents one of the biggest companies in the United States. And given their earnings outlook, it's probably due for a pullback. NVIDIA was trading at a very high multiple. That's come down. The Mag 7 are all down year to date, are all pulled back about 20%. So bear market for those stocks So it's kind of funny, obviously, when you look at Ernest trying to figure out who's going to be the winners and losers from tariffs. I didn't have my bingo card that the Mag 7 would be the biggest losers.
I don't think they are.
Yeah.
I think the reason why the big tech stocks are down, well, obviously individual names have their own things going on for them, but I don't think it's related to the tariffs.
No, I'm kind of being joking here, right, saying that, you could have done all the research you wanted and moved stocks to companies that you didn't think would be impacted by the tariffs or sell services or knowledge or sell software, things that hard to tariff, and it didn't matter.
Right.
Yeah.
No, so I think first on the international point is we've made this point many times on this podcast that the the distinction between what is an American stock or a European stock or even like a Canadian stock is often not, it's based more on where the company happens to be headquartered and whether the company is trading on that specific exchange.
Yeah.
And not really reflective of like the actual geographic locations of where the company is doing business.
Great point.
So like as an extreme example is like I was looking at a company called Booking Holdings. Like they run booking.com. And like the vast majority of their revenues come from Europe. So like, but then it's an American company that has headquartered in the US. And therefore would, if you're looking at it from like the index perspective, it would count as an American company, even though like if your specific bet is, I want to bet on Europe, right? Like Booking is probably a good bet for increasing European travel expenditures.
Well, in a way, I mean, those are awesome points. Just going back to the winners and losers in this start year to date, I think I'm kind of happy that the U.S. market is the biggest loser so far in this tariff. Well, hear me out.
Okay.
I'm kind of happy that it is because if Trump he looks bad, right? His stock market is down the most. He wants to punish other countries, but it turns out all he's doing is punishing Americans, right? So in a way, it's good, and maybe there's only so much pain they can take before they have to reverse their bully stance, so to speak.
So there's a really interesting parallel. If we look at the last, say, like after the financial crisis in 2009, there's been, I would say, 3 material stock market pullbacks.
Yeah.
There was most recently was 2022. Well, excluding like 2025 so far.
Yeah.
There was 2022 when interest rates were going through the roof and all the COVID restrictions were coming, like they were like being released and like, apparently everybody was going to go out again. Right?
2022, the economic data every month kept getting worse.
There was a supply chain.
The inflation numbers going up every single month, and the market, every time that CPI number would come down, the market would take a pullback, a hefty pullback, and the Fed would raise rates, and Canada was raising rates. And, I know a lot of people say, oh, it's so uncertain now. We have very short memories. That 2022 was not fun to live through, I got to tell you.
And then, so before 2022, there was 2020 when COVID happened and the world was shut down. Yeah,
the market in February and March of 2020, I think combined pullback of about 18.5% in 2 months.
And then people don't remember this one. Yeah. But in late 2018, the market pulled back quite materially. Yep. I don't remember exactly.
I remember. I know exactly. 2018. It doesn't seem as bad because 2017 was a decent year, and then 2018 started off really, really well, and was doing okay until the nasty pullback at the end of the year, and when Trump was threatening tariffs.
Right. No, and I think that's the most interesting parallel to today's situation because if you look at what happened in 2018, and you can go on Google and search like for news articles about why the stock market crashed in late 2018. Yeah. And it's very similar to what we're going through today. Trump had just put tariffs on aluminum and China. There was worries that interest rates were going up.
Yeah, there was worries that inflation was going to go up as a result of these tariffs, and the 10-year. It's funny to laugh at it now, but the 10-year, I think it went above 3%, and people were freaking out that it's above 3%. Today, it's over 4%, and we survived. Yeah.
And there were concerns that big tech was becoming too big as a percentage of the index.
Yeah.
There was an antitrust case against Apple. I think Facebook was going through some of their data collection issues.
Yeah.
So it's very, very similar to what we're going through today. And I'm not saying that, not to say that there isn't something to be worried about at any point in the stock market history, but I think usually people can often over extrapolate and take that to the extreme and say, well, what if the world economy blows up and we all die, right? But then that doesn't actually, even in the financial crisis and COVID, which I think were much more serious situations than we are in today.
I think so.
Things have a way of fixing themselves.
Yeah. It's easy to get caught in the doom spiral when markets are going down and you get confirmation bias from the headlines or whatever media or news you're watching or reading. It's just so easy to get really negative, of course, and easy to forget that we had meaningful pullbacks in the market in 2024. If you will remember that, we actually had a correction in 2024. 2023, not a full correction, but a meaningful pullback. Obviously, 2022, terrible. 2021 went off without a hitch, but 2020, of course, those will remember the COVID pandemic pullback and the markets recovered. And then, of course, what you pointed out in 2018. Don't tell me that there's never been uncertainty or this is the most uncertain time. That doesn't make any sense to me. Maybe there's high uncertainty with the U.S. administration for the longest time. That could be true, but impossible to know what's priced in, how relevant it's going to be, when it ends. So we posted David Baskin, our business partner, chairman of our company, did a blog about why we don't sell stocks given market pullbacks, and we'll link it to the show notes. Urge everybody to read it. I mean, the executive summary is: A, you don't know how long the pullback's going to last. You don't know which companies are going to be impacted. B, you don't know when the market recovers, if you're going to have the ability to get back in. You probably won't. C, you got to pay capital gains, presumably on a lot of stocks. And with capital gains, either A, you got to be right on the purchase and sale, or you got to be right on about getting out of the market, getting back in, or swapping for another name. It's really tough. So, the economic numbers are, admittedly not as good as they were a few months ago, but certainly not as gloomy as I think some people are making it out to be, and certainly not as gloomy as that was a pretty fast pullback in the markets. So we're hunkering down. We remain fully invested. Ernest and I are always looking for new investment ideas. Yep. We kind of like pretty much everything we own. Yeah. We got caught off guard on a few names that we didn't expect their results. But on the other hand, pleasantly surprised about most of our names. Many raised dividends. Many had very strong results for Q4, and so we'll hopefully talk about a lot of those companies as this podcast progresses for the rest of the year. Anything else you want to add there?
Nope.
Sounds good. So Constellation Software reported its Q4 earnings, I think last Friday or 2 weeks ago?
2 weeks ago.
2 weeks ago.
Before March break.
Yeah, time flies already. And Constellation famously reports its earnings on a Friday night after the market closes. It doesn't do a conference call. There's no big presentations or slide decks. I think the management is making a little more progress meeting with institutional investors. I see it's been picked up coverage by Jefferies and now UBS. So that's new. That's kind of interesting. But famously refuses to list its shares on the U.S. exchange. Yep. Even though the bulk of its revenues are U.S. dollars.
I think it's quite diversified. Yeah.
So with that, let's get into Constellation and Topicus and see from Ernest if there's any new updates on what's going on with the companies and their plans for 2025. So where do you want to start?
Maybe we can just start with an overview of what Constellation Software is.
Yeah.
Because I find that when I talk to a lot of people, they don't really understand exactly what this company is or what they do. Because it's and it's fair because it's such a unique company. Like there really isn't, well, maybe in certain parts of the world, there really isn't a company that conducts itself the way that Constellation Software does. And what Constellation Software does is it's an engine to make acquisitions of small software companies. So like most of the people that work at Constellation, their job is to pick up the phone and establish relationships with local entrepreneurs who maybe started a software company and ran it for like 10 or 20 years. And then they'll build a relationship and say, hey, would you like to sell it to us? Yeah. And
so I wonder how they start going around it. Maybe someone's in charge of wealth management companies like Baskin. And so they start calling up all the wealth management companies and say, what software do you use? What do you use for this? What do you use for that? And then you work backwards and try and figure out who makes the software. And
well, I think they already know.
They know, but I'm just, And then be in touch with those companies that make that software and have a relationship with them and say, one day, if you're ready to sell, we're the best buyers for you.
Right.
Yeah.
And that's really the whole strategy of Constellation, is that they continually make acquisitions of software companies around the world. And these are not like Microsoft or Adobe or Salesforce type software. These are what we call vertical market software companies that perform a very specific function for a very specific end market. So for example, like they have a big business that services transit systems, right? Like they help you manage like the employees tracking for the transit operator, like the fleet, like track the fleet of the buses and all those kinds of things. And so over time, Constellation continues to make acquisitions. The bulk of its growth comes from acquisitions. And I think generally people tend to dislike companies that grow by acquisition versus then quote unquote growing like organically, because the idea is like, well, you're not running your business better. All you're doing is just going out and spending money and buying growth.
Yeah.
Right. But in the case of Constellation Software, they make a very specific calculation on almost everything that happens inside the business. Do I want to invest in marketing for my software, like for the transit system example? Like, do I want to invest money in upgrading the software? Do I want to invest money in marketing and possibly selling and convincing other people, other transit systems to switch to my software? Or do I rather use that money to go out and do another acquisition of something else? And so everything is ranked like kind of and allocated based on the highest potential use of that cash. And over time, like you can see it in the results. I think over the last 5 years, revenues and profits are up 3 times.
And even stepping back, what makes software such a good business, or these niche software, is that they're mission critical software. You can't run your business without them. Typically, the capital expenditures to build these software has already been built. There's just improvements that happen over time, but it's not that expensive to run that software business.
Right.
And every new customer that you add is pretty much full margin. And once you have a relationship with a company, you're selling them this transit software, everybody in the company now knows how to use it. They're familiar with it. You pay for licenses. It's very hard to switch.
Right.
And you tend to stick with your software companies for a very long time. And you tend to pay either on an annual basis or you pay on a monthly basis, right? So there's recurring revenue.
Right.
You can't switch. You're locked in. You probably have... Everybody hates the software that they use.
Right.
It's just the way it is. But if you work with good ones, they're always trying to improve the software for you, make customizations, and maybe even charging you for those customizations. So software is such a great business to own.
Right.
Yeah.
So Constellation is kind of like the gold example of what we call serial acquirers. A serial being like SERIAL, not like cereal.
Not Fruit Loops.
And so what I typically look for in serial acquirers is, number one, like, are they continuing to make acquisitions at the same pace that they're generating? Like, are they able to grow by acquisition going forward?
Yeah.
Like, are they able to use all of the money that they're making and continue to deploy that into acquisitions to grow the business? And then the second thing to look for is the core business continuing to perform well? So, and the reason to answer this is to make sure that the acquisitions are not just basically masking over the poor performance of the things that you already have.
Great points.
And so I think you can be quite confident that both of those things are true for Constellation.
Well, you can see it in the results. You can see it in the acquired growth by revenue and revenue organic growth.
Right. Yeah.
Organic growth means the price that you raise to your customers, the other lines of software, the premiums, the upgrades, more licenses that you sell to them, and you can see that pretty much Constellation, not fast top line growth, but at least 2 to 3% a year of organic growth altogether.
Yeah, they grew 5.
Yeah, the maintenance, what
maintenance.
matters is the maintenance, the recurring revenue. A lot of the other some of the software they sell licenses, they sell hardware.
Yeah.
That stuff can be very, very lumpy. But what matters is it's growing 5 or 6% a year.
Yeah, the maintenance portion grew 5% last year.
And that makes sense, right? So for anybody who pays for software or runs a business out there, you know that your software provider generally raises prices to you 3 to 7% a year. And if your business is growing, not only do you pay 3 to 7% a year on your base, but you're also, if you're adding new employees, you have to pay for the seats, right?
Right.
So the seat license, the new employee license. So it can be a pretty good business.
Yep. And on the so the base business is performing fine, right? And then on the acquisition front, I think they did $1.8 billion of deals last year, which is a step down from prior years. I think they did more than that in 23 and 22. I don't remember the exact figure.
23 was a big year for Constellation. Two really serious acquisitions. Yeah.
But then I think the most important metric is that the acquisitions that they made still consumed all of their free cash flow. So they are not seeing any problems in continuing to find acquisitions to meet the ever-growing amount of free cash flow that they're generating.
So in prior years, 23 and 22, if that's the case, they used some debt to make acquisitions. They levered the balance sheet slightly?
No, and I think it's important to break out for Constellation, like big deals and small deals.
Okay.
And the reason to break that out is because it's actually like a different team that is doing these kinds of deals. Like the big deals, there's like a committee, there's like a guy at Constellation headquarters. His job is to go out and find big deals. And the return target that Constellation looks for in large deals is different from the return target on small deals. And so they did less big deals in 24. Mm-hmm. They only did one, which was, I think, it's like a parking management software.
Okay.
That was a big deal. In 23, they had 2 big deals, and those were even bigger than the ones that they did in 24. So that they did Wide Orbit, which formed Lumen Group, and then they also did, I think it's called Optimal Blue, which was proceeds from an antitrust case.
Yeah, so, I mean, when things come up, it's much easier to make smaller acquisitions, obviously.
Yeah. And I think the important metric is that the amount of small acquisitions that they did was higher in 24 than in 23 than in 22.
Right? So there's no signs of slowdown.
Yeah.
And of course, 2025 has started off very hot for Constellation Software. Already in Q1, which is not even over yet, Constellation has acquired, I think, $900 million of deals. So half of what it did all of 2024, and we're barely into, we're almost finished Q1. So, you don't know what the trend is. It still can be lumpy, but it could be a real record year for Constellation Software. And that's because of Topicus, right?
Yeah. So Topicus was one of the spin-offs of Constellation Software. And they are more focused historically on Europe, more outside of UK, but generally they focus on Europe. And Topicus had a bit of 2024, they didn't do as many acquisitions, and they also paid a dividend, which people generally, like the market's like, well, if you have acquisitions to make, why are you paying a dividend?
That's a TransDigm playbook.
Right.
Yeah.
No, and I think the market is saying, are you just not having enough things to acquire? And I think Topicus followed up with that in the first half of 2025, or first quarter of 2025 with some big deals.
Yeah, Topicus has already made more acquisitions in the first quarter of 2025 than it's done in its entire life. Right. So combined. So it's been an unbelievable start for Topicus. And
most of those were basically 2 deals. Mm-hmm. They did they did an acquisition. I can't pronounce these names.
Don't even try. You'll butcher them.
One of them was a software provider for Belgian local governments.
Okay.
So helping them collect taxes and those kinds of things. And the other one is not an acquisition, but it's an investment into a company in Poland called Asseco, which Asseco.
It's kind of like a mini Topicus itself.
Right, and it's from what I understand, it's the largest IT company in Poland. Topicus previously already has a presence in Poland from a company I bought called Signity,
Yeah.
where the whole idea is that Poland is not a place that they understand. They don't have the connections there to do business, and so they'd rather create this local like presence there where those people are going to go out and make acquisitions in the areas that they understand.
They want a piece of that pie, but they don't have the knowledge yet about the Polish market. So use experts there who are already making acquisitions and maybe use those as deals to eventually buy those companies outright. Don't know.
So far, as Asico, they've said they're not going to buy them out. Specifically, the stock is actually still listed on the Polish Stock Exchange. But they're working together very closely with the board and the CEO to kind of refine the strategy and kind of provide them with some guidance on how they think, you should run a business.
So this is kind of a new strategy now for Constellation, which is taking meaningful stakes of other publicly traded companies.
Yeah, they've done a handful of these over the years, and they did Adapt IT first in South Africa. They did Signity, which and this one that we talked about, Asico. So I think the real big takeaway is that the management is finding ways to deploy capital. And that's really what you want to see, because I think we follow a lot of serial acquirers, and what often happens is that as they get bigger, the pace of acquisitions just happens to slow.
It has to. I mean, that's the law of large numbers.
And that's been the bear case on Constellation all along, is that they're not going to continue to compound at the same rate as they historically have done. But the fact that what gives me comfort in owning the stock is that they keep doing all these things. And we didn't even talk about like the rebranding of the initiatives at all these and the mini constellations at all the operating groups that they've done. They keep finding ways to develop the incentive program and to find creative ways to make money, right? And that's really what you want to see.
So in the meantime, of course, Constellation Software, I think, did hit an all-time high earlier this year with the market pullback. It's come off, but it does look to be, Ernest, an exciting year for the company's Constellation and its spin-off Topicus, given the amount of acquisitions it's already made year to date. What else did you learn about from these companies in the most recent report? Anything that caught your eye?
Well, I think the one thing that is, I think some people often like to ask is, are they going to do more spin-offs in 2025? So they did two. They did Topicus and they did Lumen. Yeah. And in both cases, those were, again, like a creative way to do acquisitions, where they were able to use shares of one of their businesses and merge that with a similar business, in essence, using equity to make acquisitions. And furthermore, create like a listed company where the employees would, they can buy shares and be compensated more closely with their performance versus like the Constellation Software.
And so far, so good. Both spinoffs for shareholders as well as employees worked out very well. I think Lumen went public at $13 or $14. It's now $36. Topicus went public at, I think, $66. It's now $136, $140. So those things have worked out very nicely for the employees. So something that Mark Leonard has come up with is really working out well. A lot of people now are worried about AI, of course. And will AI displace software? Can you just say, AI, build me this software and replace what I'm currently using, and bada boom, bada bing, and that's it? I think that sounds way too crazy, but some people are really worried about how AI will hurt software. I think Constellation has a different take, though.
No, I think the first thing is to say is that this is still all very hypothetical about whether like the ultimate impact that AI is going to have on software, and for a whole host of other industries as well, where I think by and large today where we are with AI is that, people use it to help with their homework and maybe with some coding, but like the actual use cases beyond that are still a little unclear about what it's going to end up changing. So I think that's the first aspect. I think the second aspect is that you got to understand that Constellation's software, like the reason that they buy these businesses is because they're very deeply embedded into the operations of the customers. So like I was reading this case study about Volaris Group, one of the Constellation one of the operating groups that make acquisitions at Constellation.
And Volaris will eventually be a standalone company.
Right.
Yeah.
Yeah. So they bought a company that in 2020 that provides library management software.
Okay.
And so what the software does is like, catalog all the books, make it available online. And they manage the library systems in Pickering and in Richmond Hill and like all sorts of places, right?
That's part of Toronto for those that are listening from other countries. Yes.
Yeah. So the company is called Biblio Commons.
Okay.
And, this is not anything that a programmer can't already do, right? Like I don't think it's a hard software to write, but imagine if you're the Pickering library, like you're not going to recatalog all your books again with a new software just to save a few bucks, right? Like you have to, like, I can't even imagine what that would be like.
No idea.
So, to the extent that, like maybe you can spin up a cheaper version using AI now.
Yeah.
Maybe some of these companies, maybe in the future, there's going to be some markets where people rather use an AI generated version rather than switching to like
it's so hypothetical though. It's so hard to.
But is that really what a library wants to spend its time doing?
No.
Like,
and who's going to run it? Who's going to be in charge of that program? Who's the software person or the high tech person that can pick and choose what software to switch to if it's going to work better?
Exactly.
Test it.
Right.
Because right now we know that AI software makes a lot of mistakes.
Because the whole point of this software is so that you don't have to do it yourself.
Yeah.
Right. Like that's why the software exists.
Yes.
And I think one last thing I would say about this AI topic is that like Constellation could benefit from it as well, because to the extent that AI is lowering the cost of making software, it becomes cheaper for them to service the software as well.
And there could be the creation of software could become easier, more companies starting up and creating new software based on AI, which more acquisition targets possibly.
Right. And so like, for example, like one of the things that Constellation historically has not done a lot of is they don't do rewrites of their code base and migrate their customers to the cloud. They do some of it, but they don't do a lot of that because they've done the math and they say that it's not worth the time and the effort and the cost to do it, because like you can do it, but then like your customers aren't like, they're like, okay, we got a shinier software, but like you're not getting more money out of it. So to the extent that if Constellation is now able to do these rewrites at a cheaper cost because of AI, they're able to upgrade their software at a lower cost. And I think that maybe changes some of the equation about how they allocate their money.
Very exciting.
So like, I don't at all view that this is necessarily a negative. So I think that covers it well.
Yeah. So every year, though, Constellation does do a annual meeting. So kind of like Berkshire Hathaway, I think it takes place in May.
Yeah, I don't remember.
But it's virtual. It's virtual. It's not in person anymore. They don't want to do it in person because they don't want people cornering their employees and asking them how they find how they built Constellation Software. Right? They don't want to give.
I think they just don't want to travel.
Yeah,
I really think.
I thought I read that they don't want to. They feel like some of the secret sauce could be given away if I
don't think there is a secret sauce.
Yeah. Okay.
Like, no, like not that there isn't, but like there's a lot of companies and private equity firms that are trying to replicate what Constellation is doing.
For sure.
And they can't. Yeah. Well, I mean, like maybe they are, but not at the scale that Constellation is doing it. And the reason is because it's not that hard to buy software companies.
No, you just write a check.
Right.
Yeah.
But
the biggest check wins.
Creating the institutional knowledge about how to actually run these businesses and creating it into like a whole philosophy of running your business, like that's a totally different thing. And so like I think that like back up with regards to the annual meeting, like it's like a little bit sad because it used to be kind of like Berkshire Hathaway in the sense that it was kind of like a party where you can meet like-minded investors.
Yeah.
But that doesn't exist
Constellation, like Berkshire, is not really a trading stock. Those that own it and understand it tend to hold it for a very long period of time,
Right.
and tend to have a very similar mindsets when it comes to investing. So there's also some confirmation bias. There's, they're all kind of biased investors like us, but it's clear that, as Ernest pointed out, it's such a unique business model. It's one that's worked so well. Almost $100 billion market cap on the TSX, or it did hit 5,000 a share, so it was over 100 billion. It's pulled back a bit, but obviously spinning off Topicus and Lumen, you put all those together, it's an unbelievable success story. I think obviously we can admit that the future is not going to be as amazing as the last 19 years that its company's been public, 20 years.
Hard to say.
Hard to say, but obviously growing from a larger base.
Right. The compounding is almost certainly going to be less than what it used to be just because of the scale that it's at now. Like it's a lot easier to spend $10 million on deals versus like $10 billion.
But look at Berkshire.
Right.
Okay, Constellation, nowhere near $1 trillion market cap that Berkshire has, but even Berkshire is now having trouble allocating capital, right? Berkshire took a stake in Domino's Pizza, which is a $15 billion market cap company, and it already owns 7% of the stock, right? By buying how much worth? $2 billion worth or $1 billion worth? So
and it's completely immaterial to Berkshire.
Completely immaterial. $1 billion Berkshire spending on Domino's Pizza. It sounds like a lot of money, but it's nothing for Berkshire. Yet it's a meaningful stake in that company. So I guess the point is, at some point, Constellation will run out of juice, but we think they're still a very long way away from that.
Right.
And you don't know how the future is going to play out, what other businesses are going to buy, how maybe they'll be launching organic growth software vehicles. Who knows, right?
No, they did launch
exactly
a venture, VMS Ventures.
Exactly.
So
and there's been a few startups there, a
couple.
Yeah. Nothing I think material yet, but you never know.
Right. And and then there's even beyond software where, like, for example, Mark Leonard has talked about buying a thermal oil company before, which has kind of nothing really to do with software at all. Yeah. But like,
well, he's
there to make money. Yeah. He's not there to run software businesses. Right.
They've studied all these high performing industrial acquirers like Amatec and Illinois Tool and TransDigm, and continue to learn from those companies how they make acquisitions, how they perform well in their niche industries, and there's no reason why Constellation can't move on to other sectors at some point in time. We'll just see. And any other relevant points you want to add to the Constellation Topicus story before we say goodbye?
No, not really. I think we covered it quite well.
Cool. So next week, we're going to talk about energy. The Canadian energy stocks have been doing quite well year to date, and Suncor, CNQ, Tourmaline have picked up, of course. Natural gas prices have picked up. Although oil prices are still depressed, we still have a tariff war, a trade war, lots of stuff going on, but we're going to do an update on the quarterly reports from the year-end reports from Tourmaline and CNQ, and talk a little bit about energy. So we'll see you back here next week. Take care. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.